So, back in August last year, the global markets, especially in the US, suddenly collapsed. Now, this was long before Trump's tariff war or China's deep-seek surprise. It was thanks to the yen carry trade unwinding. Japanese interest rates started to rise, and the yen strengthened against the dollar, and that sparked a big run on US stocks. And at the peak, US stocks fell by more than 8.5%. More than half of the collapse came from the Magnificent Seven tech stocks. It was a sudden bloodbath that really took everyone by surprise. And this was during a period when everything was humming along for the US economy. Biden was still president and Yellen was busy spending money like crazy. The system was being held together by deficit spending that hit 6.7% of GDP. The situation is very much different today. Besson wants to rein in spending and cut down government expenditures. In addition, Trump's trade war is really backfiring and we can see it directly in the markets. The S&P fell from the peak by 10%, entering correction territory. And this was one of the fastest collapses in US history, dating all the way back to 1928. And that really shouldn't be a surprise. When you cut deficits for an economy addicted to government spending, revenues for companies would most definitely come down. With the Atlanta Fed calling for a contraction of over 2% in Q2, investors they see no point in holding US stocks, especially when valuations are sky high. It's important we understand the big headwind coming for the economy. According to Bank of America, 34% of US GDP comes directly from government spending. The remaining two-thirds comes from the private sector, and both are under enormous pressure. When Doge continues to cut federal jobs, people have less money to spend. Simple cause and effect. And Besson wants to shift spending back to the private sector. Now, in an ideal world, that is the best case solution. It's why China, for example, is trying to boost their own domestic demand. However, you can only do that by stimulating your economy, something that is impossible for the US today. US job growth is extremely skewed. 85% of growth is reliant on federal jobs and sectors dependent on government spending like health and education. But how is job growth going to come back to the private sector when their revenues are connected to domestic spending itself? Plus, Trump's trade war is triggering global boycotts, so foreign revenues could collapse in Q1 and Q2. And the last thing the US needs is an external shock, but it looks like a big financial event could be coming from Japan. Another yen carry trade unwinding might be on the cards once again. It's critical we understand how the yen carry trade works, and you realize how much of a disaster this can get. Over the past decade, Japanese investors have been borrowing their local currency, the yen, at near 0% interest rates. They then invest the money into US Treasury bonds, earning a yield of more than 5%. In other words, as long as interest rates don't move, they can farm a free 5% profit. In fact, if the dollar strengthens and the yen collapses, they benefit even more. They can pay down the yen debt that is devalued against the dollar. Now, in August 2024, that plan started to come crashing down, and we are beginning to see the same ingredients build up once again. Over the past month, the US dollar has been falling hard. At the same time, the Japanese yen has been rising dangerously fast against the USD. At the same time, US bond yields are starting to drop, while Japanese bond yields are headed higher and higher since January. The yield on Japan's 10-year bond is well past 1.5%. Contrast that to January when yields were less than 1.2%. This comes at a very bad time when US yields are dropping because of recession fears. Everyone expects the Bank of Japan to hike rates further, which once again places tremendous pressure on the yen carry trade to unwind. The higher JGB yields go, the more attractive it gets for local Japanese investors to sell their dollar bonds and pile it back into yen assets. When US yields drop, this poses another problem to the USD. Since January, the yen has been appreciating against the USD. It has strengthened by over 6%. In other words, the dollar has fallen against the yen by 6%, which is a big headache for Japanese holders of US debt. Even if you're getting paid a 5% coupon on your treasury bond, there's no point. You still need to sell the dollar proceeds for yen to pay back your loan in the Japanese currency. And that means realizing an overall 1% loss on your investment. And as Trump continues to wage his crazy trade war, this places even more pressure on the dollar. Investors are now spooked about a recession, so they drive down US bond yields further, and this makes the yen carry trade even less attractive. And Scott Bessent just confirmed the unthinkable coming in April.
With a tariff plan, reciprocal tariffs, if you drop yours, we'll drop ours. We are already seeing some of the worst offenders come down. April 2nd is an important day, but I would also tell everyone to look what happens from April 2nd to say June 30th as the other countries come down too. And President Trump's created a win-win situation here. Either the tariff barriers come down, the U.S. can export more, trade is fairer. It's always been free, but not fair. And then or if they don't do it, we'll take in substantial revenues.
So Besson is making a very huge assumption here. If all the tariff barriers drop, then yes, the dollar might strengthen. But if the world hits back, then demand for the dollar could fall even further. Foreigners could buy fewer US goods and send the dollar strength tumbling down even more. And it makes it even more likely for Japanese investors to pull away their US investments. They will take their ball and simply head back home. In 2024, Japan's foreign investments have ballooned to nearly 490 trillion yen. That's $3.4 trillion. This includes foreign reserves and private investor money, now the bulk of which are sitting in US assets. So the dependence on Japanese money is there. The weaker the dollar gets and the lower US yields get, the greater the incentive for a Japanese rug pull. Considering the chaos in the markets today, it would be very ugly. Japanese exposure to the US bond market is starting to build up thanks to recession fears. Investors bought an additional $23 billion worth of overseas bonds, mostly in treasuries last month, the highest addition since August 2024 when the yen carry trade unwinded. So the risk in the system is starting to reaccumulate once again. Not a good sign when Trump wants to bring US yields down further when Japan wants to hike their own rates up. For over a year, Japan has been facing the threat of higher inflation from the collapsing yen. Their industries are in trouble and domestic prices are going up. But hiking rates was risky thanks to the debt situation. But now, they are forced into a corner where domestic stability is more important. Even as US yields are dropping, Japan has to hike theirs higher to fight inflation. There's a reason why the Bank of Japan is resolute in their decision to keep hiking rates. It's because prices are getting out of control. Back in 2024, we said Japan's inflation would get worse thanks to their yield curve control. When you suppress bond yields enough for a long enough period of time, you will weaken the yen to the point of collapse. And that's what happened back in 2023 and 2024, especially when power kept rates higher for longer. And now the fateful day has come. Japan's overall inflation has accelerated to the fastest since June 2023. Inflation in Japan is now higher than the US and the Eurozone, which is simply insane. 4% versus 3 and 2% respectively. And this hits Japanese consumers who are already very conservative spenders. Their savings rates are higher and they have higher household debt versus the US. Higher inflation won't make them spend more. In fact, they will be forced to scale back. Food prices are already out of control in Japan. Cabbage, for example, is 3 times more expensive in January 2025 versus 12 months back. Across the board, prices are more than 30% higher, from rice to oranges to chocolate. Household budgets are getting squeezed. Over 60% of Japan's food is imported in, which makes them very vulnerable to currency movements. So to combat this, the yen has to strengthen. The currency is still too weak today. And the fastest way to accomplish this is for the BOJ to hike interest rates once again. Because of this, it's not a good situation for the US markets, especially American stocks. Both the BOJ and the Federal Reserve, they are trapped. Trump's engineering a recession to force the Fed to drop rates, while the BOJ is being pushed to hike rates thanks to inflation. And here's a big sign that Japan is serious about raising interest rates. Their regulator is moving to crack down on risky loans backed by JGBs. It's just like the mortgage-backed loan crisis in 2008, but this time, the underlying risk is from Japanese government bonds. Now, how is this a threat? Well, if the BOJ starts hiking rates, the value of existing government bonds starts to collapse, and that erodes away the underlying value of the collateral. You might just get 50 cents to the dollar or even worse. And if the repackaged loans, $67 billion of them, starts to default, it could trigger a nasty chain effect. A lot of money will be lost and a new systemic disaster might occur, which tells us Japan might be gearing up to raise interest rates very soon. The problem that everyone has forgotten about is about to come back. Even the domestic risk in Japan is building. If these repackaged loans themselves blow up, it could create a big liquidity hole. A lot of money could go missing. Since 2022, more local lenders in Japan are buying up all these risky loans backed by JGBs, from under 3% of holdings to nearly 6% of holdings today. And this is what happens when you chase yield. If this blows up, lenders might be forced to sell their foreign assets, including US stocks and bonds, to plug the hole. And that's how interconnected the global markets are. What happens in Japan will affect how investment money flows. The headwinds we face today are serious and it's global. As the dollar falls further and as the trade war escalates, it just makes the situation worse for US assets. During an interview, Besson confirmed that he isn't worried about market corrections. In fact, he calls corrections healthy, which means there isn't any Trump put or bailout coming. Once again, Besson is not ruling out a recession, and a plan to crush government spending is still on track.
Mr. Secretary, can you guarantee the American people here and now that there will be no recession on President Trump's watch?
Well, Chris, you know that there are no guarantees. Like, who would have predicted COVID? Right. So I can predict that we are putting in robust policies that will be durable. And could there be an adjustment? Because I tell you that this massive government spending that we'd had, that if that had kept going, we have to wean our country off of that. And on the other side, we are going to invigorate the private sector.
What exactly do you mean when you say adjustment? Could that potentially lead to a recession?
There's no reason that it has to, but I can tell you that if we'd kept on this track, what I could guarantee is we would have had a financial crisis. I've studied it, I've taught it, and if we had kept up at these spending levels, that everything was unsustainable. So we are resetting and we are putting things on a sustainable path.
Long term, I agree with him. US deficit is unsustainable, but as he said, he can't guarantee a no recession scenario. So in the short term, the spending cut could send a big shock to the markets. Plus, what happens in Japan could be the straw that breaks the camel's back. So hang tight, guys. The US is determined to slow down the fuel that drives stock prices. Every policy from Doge to the trade war is all about reducing the deficit. And for US stocks that were addicted to endless government spending, this really spells a world of trouble. But let me know what you think. Will Japan deflate US stocks even further? And can the United States avoid a recession? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.